Hello, everyone. Thanks for tuning in to another Bite Size with Britt video, where I aim to bring you new digestible content on relatable topics every Tuesday morning. And of course, you're more than welcome to let me know in the comments below if there are any specific topics you'd like me to cover in the future. As I mentioned last week, today we are switching gears completely to talk about finances. This topic is obviously relevant to all of us all the time, but it's particularly relevant right now since we're in the middle of tax season and April is also Financial Literacy Month. And it's relevant for me personally since, as you know, we're getting ready to welcome our first baby into the world sometime over the next few weeks. So we've been spending a lot of time rebudgeting and considering different aspects of our financial picture, such as setting up an RRSP and deciding whether or not it's worth it to provide a down payment to secure a daycare spot. These last few months have opened up more financial questions for me and have made me realize just how much I have to learn in this area. Since I am most definitely not an expert in this area, today I am leaning on the knowledge of one of my friends who recently switched careers and has since quickly become a very successful wealth coach and financial advisor. I found Ryan's responses to my and some of my friends' questions super helpful, so I hope you do too. And be sure to stick around to the end to hear how you can get in touch with Ryan if you have any other questions or if you just want to learn more. Let's take our deep breath to clear our busy minds so we can absorb this information, and then we'll dive in. On the count of 3, 1, 2, 3, in and out. Hey Ryan, welcome to Bite Size with Britt, and thanks for being here. Do you mind introducing yourself and then talking about your big career pivot about a year and a half ago from a lab technician to an independent financial advisor, and a very successful one at that?
Hey Britt, thanks for asking me to do this. My name's Ryan, for those of you who don't know me. I'm a wealth coach for Aspire Wealth Group in Ottawa. And before this, I was in the science industry working as a lab technician. So I can tell you a little bit about how all of that happened and how I ended up switching careers. So when I first moved to Ottawa a few years ago, I had to take a pay cut for the job that I got here, and I was put on 12-hour shifts, which I hated right away. I applied to hundreds of other jobs while I was working there, like most people do, in the science industry, internally and externally, with no luck, and I was just getting really discouraged. So I do have a Bachelor of Science degree and 2 years of work experience prior to this point. And my job didn't really have a lot of room for growth. So after staying there for a couple years and working during the pandemic, I ultimately decided that it wasn't going to be the right fit for me long term. So I started thinking about what line of work I wanted to do and go into where I could be totally in control of my income, have a lot more flexibility in terms of the hours, and just do something that I would never get bored of. So I always thought that working in finance would be a really cool job, and I was really interested in learning more strategies that would help me build wealth. So I ended up connecting with someone who I knew was working as a financial advisor at the time, and they introduced me to the hiring director at their company and basically got me into the whole onboarding process.
In your words, what is a financial advisor?
In my words, a financial advisor is someone who's there to help guide you through major life events and difficult financial decisions that you're going to have to make throughout your life. And they're there to help you identify what your goals are and work together with you to achieve those goals, whether that's learning how to diversify your investments so all your eggs are not put in one basket. Maybe it's helping you retire at age 55 instead of 65. And basically just helping you stay disciplined when it comes to saving and managing your cash flow, which is really important. Most financial advisors who are also independent, like myself, so what that means is someone who's self-employed and doesn't necessarily work for the big banks, but they might work at a different company. We're usually dual licensed in investments and insurance. So we can also help you get different types of coverage, whether that's life insurance or disability insurance, so that you can protect that wealth that you're working so hard to build and just make sure that your family will be okay financially if something happened to you or you weren't able to work.
For those who are graduating or have recently graduated with school debt, credit card debt, etc., and are just beginning their careers, what are your top tips for tackling this debt? And should new grads focus on building savings at the same time or just focus on tackling their debt first?
If you're someone who still has a lot of debt to pay off or recently graduated, I definitely suggest focusing on the higher interest debt first. So typically credit cards are one of the highest with around 20% interest rates. And that's just a huge hole that gets deeper and deeper the longer you wait to pay that off. If you have some lower interest debt, like your student loans or maybe a car payment, then potentially it could be okay to make those payments while still saving for future goals. So, of course, it depends on how much you're able to save after your bills are paid, depending on your lifestyle. But the more that you can save and the more you can lower your expenses, the better. And there are always ways that you can improve your financial situation. So, you really just have to make it a priority and not let your ego get in the way. And what I mean by that is you might need to live at home for a couple of years while trying to pay off your debt. Maybe buy a used car instead of a new car if you're in the market for one, or potentially get a second job for the short term. So I feel like there are always ways to either make more money or spend less, and sometimes you just need to make those sacrifices if you want to improve your finances to get ahead.
Big congrats to you and Dalton on your recent engagement. When I got married a year and a half ago, I was absolutely astounded at wedding prices. We had a very small wedding because of the pandemic, so I can't even wrap my head around the total cost if we had done something larger. Since you are in the midst of wedding planning, can you share with us a few steps you are taking to ensure you don't accrue too much or any debt through the wedding?
I am engaged and planning a wedding in December, and luckily we haven't had to take on any debt or pull out any money from our investments. And I don't want to sound like a broken record, but the biggest tips that I would suggest would be to try and minimize your spending as much as possible after you determine what your savings goal is. So most of the time the big bill comes maybe within a month of the wedding, and up until that point it's just small deposits that you have to make. So you can really determine what your savings goal is and work backwards and save a certain amount per month, and then try and spread out all of the smaller stuff throughout the year so that you're not spending a crazy amount in one month. There's also tons of ways that you can cut back on certain things for your wedding and just decide what's really important to you and worth the money. Maybe you've been dreaming about your wedding dress your entire life, like I was, or it could be getting the best photographer, or maybe it's splurging on a weekend away for your bachelorette. So, whatever it is, your partner and yourself should sit down, discuss what a realistic budget is for your situation, and just identify the areas that you could really cut back on. It's important to try and stay out of a negative cash flow situation and not rely on using a credit card for your expenses.
What are a few important financial considerations when starting to think about buying a house?
If you're starting to think about getting a house, which I'm sure a lot of you are, I think it's extremely worth it to sit down with either your financial advisor, maybe a mortgage broker, even your accountant. We are all different types of professionals that can help you do a full financial analysis and review your situation so that we can determine if it even makes sense for you to start looking now, maybe in a couple of years, or maybe you might have to wait even a bit longer. So it's important, first of all, to get pre-approved so that you know how much you're qualified for. And then you can decide how much you'll allocate towards your down payment and what mortgage payments you'll be able to afford. So afford does not mean living paycheck to paycheck or going into debt. It means still being able to save for your future with your new increased living expenses. So there are also a lot of extra costs you have to consider, like the land transfer, property taxes, home inspection, the lawyer fee, probably getting new furniture when you move in. And if it's a new build, you want to think about things like installing blinds. So all of this really adds up. And not only that, but it's also going to be really beneficial for you to have an emergency fund set aside for things like some additional maintenance fees that might come up over the years when you are a homeowner.
We're all aware that a higher credit score gives you more options in terms of the loans you may qualify for, the rates of the loans, and so on. So it's therefore important to be aware of your credit score and to try to optimize it as much as possible. What are some tips for improving your credit score?
My biggest tip for improving your credit score, especially when it comes to using credit cards, is to pay your balance off completely every month and also using the 30% rule. So if you haven't heard of this before, the 30% rule means not using more than 30% of your credit card's limit before you pay that off completely. So for example, let's say that you have a limit of $5,000. What that means is you're only going to let your balance go up to $1,500 before you pay that off, because this really shows the lender that you're not desperate for credit because you're not even close to maxing it out. You can consistently make those payments, and both of these are key in improving that credit score. If your bank offers a credit limit increase, this isn't going to hurt your credit score as long as you don't increase your spending by too much and you continue to make those regular payments. So using my previous example, it could even improve your score if you're staying under that $1,500 balance, since that's going to lower your credit utilization ratio.
So I actually first heard about the pay yourself first budget strategy through one of your informative Instagram posts. And you mentioned that this is your favorite budgeting strategy. Can you explain this strategy and tell us why it's your fave?
When it comes to budgeting and managing your cash flow, I love the pay yourself first method because I don't really see any other way that someone could be so successful at sticking to a savings plan. So pay yourself first means that as soon as you get paid, you already know exactly where that money is going. So first it might be to your bills, your debt payments, and then your savings and investments. So what's left over is what you can spend on literally anything without feeling guilty about it, because you know that you've put your money towards all those other things first. So this is a great way to prioritize saving above everything else. And it does not require you to track every single thing that you spend money on, like some other types of budgeting examples might have you do.
Do you have any strategies for communicating to your partner about finances?
I totally think that money should be talked about very early on in your relationship with your partner. You should have a pretty good idea about what their money habits are before things start getting serious. And it should be a frequent topic of conversation between the two of you, especially related to goal planning and what steps they're taking to save for their future. Both individuals in a relationship should be involved in either managing your finances or at least being aware of what's going on and always being open-minded to learning more. There are ways that you can make it fun to do a financial review with your partner, like going on a date somewhere instead of doing it at home every month. And speaking from experience, my partner prefers for us to schedule some time on the weekend rather than bringing it up on a random work night when he just gets home and he really isn't that mentally prepared for a big conversation. So maybe it's just doing something like that that works for the both of you.
Is it necessary to set up an RRSP if you are already registered in a pension plan through work?
If you're already set up with a group registered retirement savings plan and a pension, that's amazing. But I still strongly encourage you to have your own individual retirement savings plan on the side of that, especially when it comes to anything to do with your employer. You never really know what could happen. Maybe in the future, you decide to switch careers like I did. Maybe you get a better job that doesn't have a pension. So there's a lot of different scenarios to consider. Maybe you want to retire 10 years earlier, but if you've been relying on your pension this whole time, you might not have enough money to do so. I love this question because I think it's never too early to start building up your own little nest egg. It's also huge to start earlier rather than later, because if your money can be invested for longer, then you have more potential to accumulate that compound interest over time. And that's honestly a difference of thousands and thousands of dollars in retirement.
Okay, last question, Ryan. If people have more questions for you, how can they get in touch with you?
I really hope all of that was super helpful. And if you want to stay in touch or get a hold of me, you can look at our website, aspirewealth.ca, for more information. I'm also on LinkedIn if you want to connect with me there. And you can follow me on Instagram at MindBodyGoals, where I share a lot of other personal finance tips.
Okay, big thanks to Rianne for sharing her time and knowledge with us. As she mentioned, you can feel free to connect with her on LinkedIn or Instagram, or to check her out on the Aspire Wealth website. And I'll link to all those pages in the description below. I know I've learned a lot from her digestible and easy to understand Insta posts, so I definitely recommend you go follow her there. As I mentioned at the beginning, I've been making a conscious effort to expand my financial literacy in preparation for our first baby arriving very soon. So in addition to reaching out to a financial advisor and to Rianne for some advice, I also joined a 3-week financial literacy challenge this month, which I wanted to share with you. This challenge was created by Tori from her first 100K, and I actually first heard about Tori through Rianne. Tori is particularly passionate about helping women feel more financially confident, and this challenge gives you a small, actionable task to do each day to help you improve your financial understanding and move towards achieving your financial goals. I'm having fun and learning lots participating so far. I'll also link to her Instagram and website below if you want to check out her great resources. Okay, that's all for today. I hope you learned something new. Now let's take a deep breath together before we jump back into our busy lives. On the count of 3, 1, 2, 3. Have a super week, everyone.